Good morning. I hope you are well and warm. Welcome to spring, although I feel the arrival of spring has been greatly exaggerated this year. In fact, I can't believe it's September already. Only 114 days left for Christmas, shopping days. And speaking of Christmas, if you're looking for a gift for your niece or nephew or children or grandchildren, Sygnia has the perfect gift for you. Introducing the Sygnia Stargazer, our latest product. It's aimed specifically for investing for children. And the key to the product is that it's simple and it's easy to invest. Online application forms and 3 options. Green for sustainability, blue if you like technology, and yellow if you like low risk. And there's also a glide path with optional de-risking a couple of years before the fund matures. If you'd like to know more, there's more information available on our website, so please have a look. Very exciting, unique product, and great gift for your family. But moving on to the markets, let's have a look at August in review. It was a risk-on month, fortunately, despite what happened in Afghanistan, as the Delta variant fears subsided and allowed markets to rally. So there was a sell-off in oil, as well as the safe haven. So gold was down for the month. The US dollar was down for the month. Developed market bonds were down for the month. And there was a rally in pretty much all equities. EM equities in particular had a great return, and Japan even better return, as their market has been under pressure with the concerns of the Delta variant. And what is interesting, if you look on this chart, as you can see there, that the only equity market that was down the month was the Chinese investable equities, which has a very high weighting to Chinese tech, whereas Chinese domestic equities were actually up. Unfortunately, the China exposure we have in your balance funds is Chinese A shares. It's the onshore market, which has a very low weighting to tech, and as a result, has done relatively well compared to the heavily weighted Chinese tech stocks, which are down more than 50% from their highs in February. But the key or the highlight for the month was definitely the red alert for humanity. We had the United Nations Secretary General declare this code red, putting out a landmark report, saying that without drastic emission reductions, the planet will warm by 1.5 degrees. And sea levels could rise by as much as 15 meters by 2300. The past decade was also the hottest in the last 125,000 years, at which point sea levels were 10 meters higher as well. So it's also always good to know where we were in the past, even if it was the long distant past. And that's the world does move in huge long-term cycles. But carbon dioxide levels are at 2 million year highs. Again, quite a seriously impressive number. And the report says that to achieve the viable targets, the whole world needs to be at net zero by 2050, which is a pretty tall order. Oxfam came out to say that these net zero targets are distractions, and they could force 80% increase in food prices, creating more hunger in poorer countries. There's always 2 sides to the story, and particularly when developed markets seem to be or use 7 times more energy than emerging markets, you have to wonder if a one-size solution fits the entire world, where the developed market doesn't need to do more than emerging markets. The UN also said that their findings should be a death knell for coal and fossil fuels, while the IPCC estimates that burning fossil fuels actually reduces global warming by half a degree. That's as a result of all the pollution it pumps into the air, and the pollution is highly toxic and poisonous. So I'm not for any reason saying that it's a good thing, but just again, there's always 2 sides to the story. All that pollution that gets pumped into the air reflects sunlight and actually leads to global cooling to some extent. Not on a net basis, but it does have an impact. So always 2 sides to the story. I certainly am a believer in climate change. I'm not saying I'm not. The story is more complex than just a code red for humanity. And as I've said consistently, I think the most important thing is for us to consume less, as well as to consume better. And that we seem to be doing. The chart on the right here shows the world energy use, kilograms of equivalent oil per $1,000 of real world GDP. And that's been falling over the last 25 years and is expected to continue to fall. So as long as we're becoming more efficient, then we will be actually doing the planet a lot of good by reducing the demands that we place on it. And certainly you would think that through COVID, the world has had a chance to recover. The last 2 years, mobility has been a lot lower, a lot less demand on oil as people have traveled less. The new normal should see a lot less travel as well. A, it's just more difficult. B, it's not necessary as much, particularly for work and the work from home. Zoom technology is certainly making life easier to do in a virtual reality basis. But what is important from this aspect is that despite the increase in the Delta variant, mobility has recovered. So the chart on the right shows that we're clearly in a third wave. It's a light red line there showing the third wave on a global basis that's picked up. But the dark red line shows the Google Activity Index. And here, yes, we're not back to levels that were prior to COVID, but we are steadily increasing. So despite the Delta variant, and despite it reaching New Zealand for the first time, despite half of Australia now being in lockdown, the world continues to learn how to live with this pandemic. It's not just that. Obviously, the vaccines are having a big impact in the developed world where they have been rolled out. But also, it looks like previous COVID-19 infections for other variants, so there is the Alpha or the Beta variant, appear to provide as much, if not more, protection against the Delta variant than the double dose vaccine. So it's certainly leading to some sort of herd immunity. And the estimates going around for South Africa are that 4 out of 5 people have been exposed to COVID. And I think despite our slow rollout of the vaccine, although it has accelerated, we're now over 12 million vaccine doses. In fact, I think just this morning we're at 12.8 million vaccine doses, which is fantastic. But despite that, 4 out of 5 South Africans have been exposed to COVID. And this anecdotally makes sense. If you think of who you know, I mean, I can't think of one friend or one colleague who hasn't had at least one person in their household who's tested positive or been sick. And the way this is, just so contagious that it's hard to believe that if one person in the household has had it, that the rest of the household hasn't. More likely they are asymptomatic or have just have herd immunity of some kind. So I think that the combination of the vaccine and herd immunity is certainly allowing, and learning to live with this, is certainly allowing the mobility to get closer to the old normal. Not where it was, but closer. And as long as it continues to creep in that direction, global growth will continue to recover. And we certainly do think that growth will continue to recover over the next 6 to 12 months. We're not forecasting a recession. We do think equities will continue to move upwards, and that bond prices will fall as bond yields continue to rise. So as a result, we remain overweight our value ETFs. In fact, we topped up value, and I'll get to that later. And we remain underweight global bonds. We don't hold any global bonds, don't hold any gold, not only because they're distorted by QE, but we do think growth will recover continue to recover, and that's not great for your safe haven assets. And in particular, we are expecting to see more of this convergence of vaccinated populations as the developed market starts to slow down or stall even, and emerging markets continue to accelerate off their very low base. So looking more at each of the regions for the month of August, this is a lovely chart, or picture, sorry. We're used to the current presidents, but here we have 2 past presidents in the US making history this month. We've got George Bush Jr. and we've got Richard Nixon. Richard Nixon is here because he, 50 years ago, in 1971, at $35 an ounce, ended the US's gold standard. The US would no longer accept or provide gold for dollars that were handed in. And we look at how gold has done over the last 50 years as a result. And George W. Bush was the former US president who launched the war on terror in Afghanistan. And 20 years ago, he launched that war on terror. And 20 years later, and $2 trillion later, Biden has ended that war on terror. So two landmark anniversaries this year, looking at the US. So what about Afghanistan? So the speed at which the Afghanistan government's collapse was quite terrifying. Less than 10 days it took for the Taliban to retake Afghanistan. And certainly led to condemnation of the US by most of the world, United Nations, but we don't think it's going to have a big impact on Biden. Certainly, Americans have shown very little support in the war against the Middle East, and they don't seem to be too perturbed that Biden has removed his troops from the region. In fact, we do think it's part of a strategic focus of the US away from the Middle East to focus on what they see as the biggest threats going forward over the next decade. And that's certainly China and Russia, both from a technology perspective and a military perspective. So I think they're no longer worried about the Middle East. And certainly we are expecting the US and Iran to negotiate a deal on the nuclear strategy of Iran. So a nuclear deal is likely. And that means that there's probably not going to be too much volatility. I'm sorry, there will be volatility, but we don't expect oil prices to continue to rise. We think that the US-Iran nuclear deal will allow additional supply to come online. OPEC 2.0 plus is already from October adding additional 400,000 barrels a day to oil supply. And we think that they will continue to add more oil as demand starts to recover. Demand is still well below where it was. And as a result, we don't see oil having a big impact on inflation or being a big key risk going forward. Sitting at $70 a barrel, and it's probably going to rotate around that, maybe dropping down to $60 a barrel and being in the $60 to $70 range. So moving on to gold, the chart on the right here is I think quite fascinating. It's a 50-year chart, and we have the worst performing in the dark green is crude, black gold, if you want to call it, oil, and that hasn't kept up with gold or equity markets over the last 50 years. So in real terms, if you're using the S&P price index as your benchmark, oil has underperformed. It's not as expensive as it was 50 years ago. Gold has kept up in real terms. Well, in terms of if you could choose between equities and gold, well, the price index in this sort of green color here, third from the bottom is the S&P 500 price index, and then the gold is in the dark blue color, purple color. And you can see there over the last 50 years, almost an identical return from US equities, price only, and gold. However, if you add in your dividend yield from the S&P 500, your total return index, the light green, you can see it's nearly 4 times the return of the price index. So I mean, a number of takeaways. So the one is that dividends are very, very, very important. It's not just about capital growth. Yes, the last decade's all been about capital growth, but dividends are important. You need to focus on dividends and the dividend yield. Because the dividend yield certainly is your differentiator if you are going to hold your slightly extra risky assets like equities. Secondly, yes, gold has kept up, but it hasn't done nearly as well as equities on a total return basis. So if you are prepared to take on some volatility, then equities are probably a good place to be. Gold has certainly not been without its volatility. And in fact, gold is often used as a supplier of liquidity in last resort. So although in small drawdowns, it may protect capital, in large drawdowns, as we saw in March of last year in the COVID recession, gold fell rapidly as it was liquidated to use to fund living expenses or other investments. So it's not the safe haven that it is always meant to be. It is a nice diversifier, but it comes at a cost. So we continue to avoid holding gold in the funds. There's no strategic weight to gold. Gold is something you can definitely trade. I mean, there's a lot of volatility in it, and you can take tactical weights. But right now, with QE distorting global bonds, and as the fund's not holding any global bonds, we prefer to stay away from gold. And Bitcoin, and I see Bitcoin's back up above $50,000. It hurts to see that. But it's certainly something that we're very comfortable not to put in the portfolios. We are actually looking at options to provide it as a product for retail investors, but not something we'd recommend. But certainly there are people with very high risk appetites who like taking the lotto and or going to the casino, and maybe Bitcoin might suit them as well. Sticking with the US, we are concerned about US on a number of areas. So we remain underweight the US, and US funds all are overweight. So they are overweight in emerging markets, are overweight in tech, are overweight in healthcare, in global property. All of those overweights are funded by the US. And one of the reasons is valuation. The chart on the right here shows bottom-up analyst expectations for S&P 500 margins. And you can see there the dotted line is the forecast. And they're forecasting margins to rise from an already very high level of 12% up to nearly 13%. And I just think that, or we feel that, given the uncertainties in the world, that such a rapid increase in margin is likely to disappoint. And disappointing earnings will certainly lead to disappointing share prices. So, valuation and too aggressive earning expectations are certainly one reason. The other is the large weight in the US markets to tech. And the US has been the stellar performer over the last decade. It has outperformed the rest of developed market and emerging markets massively. But that has been driven almost entirely by large cap tech stocks. Well, they weren't that large cap, but over the last decade, through amazing performance, they've become large cap and are certainly the dominant driver of the US. So we think that they're going to face headwinds from two main factors. One is increased antitrust legislation, and I believe today there's already further antitrust legislations or investigations that are going to be led against Google. And Biden looks like he's going to focus on this quite strongly. He's been supported by Elizabeth Warren, who's really rallying him along. And there certainly is a lot to look into large caps when it comes to the monopolistic practices and the abuse of consumer data. But I think also very important is the potential or the potential harm that social media is doing to people. There's a very strong correlation between US depression rates and social media usage. Obviously, correlation is not the same as causation, and I'm not in any way claiming that it is, but there is a strong correlation that it does need to be looked at. And there is a possibility that social media firms could be the equivalent of the cigarette companies in the 80s, and they could face heavy regulations over the next decade, including age limits. I mean, we'll get to China later, but one of the things China has done is it's limited it to gaming to minors to 3 hours a week. Maybe that is something that's healthy to do. Maybe it's healthy to limit minors' exposure to social media as well. It's definitely not a short-term risk. It's probably not even a medium-term risk, but it is a big long-term risk, as China has recently pointed out. And that's definitely not being priced. So when it comes to the US, although we had a very dovish Jackson Hole, and if anything, tapering risks were put to bed, but at some point the US will have to taper, and those risks aren't being priced into either the bond market or the equity market. And so we prefer just to underweight the US. Not only are we underweight the US, but this month we rotated more of our US out of the S&P 500 into a US value ETF. So we've increased our value exposure, this time not a world value, but a US value. And US value's got very high weights to banks and industrials. I mean, like industrials, from the fact that it's correlated to the infrastructure spend that's going to happen in the US. We like banks because banks will do well as the yield curve steepens and as US interest rates start to rise. So we made that shift, basically downweighting tech, the large cap tech, and looking at other avenues for exposure. Now, I need to repeat this because there were some concerns last month when we sold out of the FANG fund. The US makes up 67% of the global equity index. We're about now 13% underweight. So we still have more than half the fund in US equities, and 40% of that is US tech. So they're still great companies, and we still think Apple and Amazon and Google have phenomenal moats and are great businesses. But we do think that it's good to downweight those from an index perspective, and that's what we've done to manage risk. But there's still a very large, I mean, if you're on a drill-through basis, you have to see the biggest exposure to any one stock, it's probably still Amazon and Apple. So we're not saying we're not selling out of that completely. We're just reducing that exposure to a level that we think is appropriate relative to the risk and expected returns that are there. When it comes to regional, this month it was all about the US and China. Nothing from Europe that was too exciting, or the UK that was too exciting. China certainly stole the limelight. Here we had President Xi, who laid out a plan for common prosperity. Beijing intends to grow the size and the well-being of the middle class. And that is the foundation of the country's strength. And it's certainly why we believe that China is a great investment over the next decade, is that emergence of the middle class. It is the biggest middle class emergence out of anywhere in the world. And so any long-term plans, and this is a long-term plan, it's 2048, any long-term plans that are designed to entrench and benefit the middle class has to be a good thing from an investment perspective. And 2048 does mean that there should be time for a smooth transition. However, the way it was done this month was certainly anything but smooth. I mean, the speed at which regulations, potential regulations, have been rolled out, and the uncertainty that's created, it was certainly incredibly disruptive. And we've seen how Chinese tech stocks have fallen more than 50% from their February highs to their August lows. We did, well, hopefully we've seen the low, for a relative low in August, and we did switch some of our Chinese A shares, so the mainland China, which doesn't have much tech. We switched a little bit out of that into the investable indices, MSCI China, which has got a lot of tech, to take advantage of the incredibly oversold positions. We do think Chinese tech is oversold. We do think that it's a short-term opportunity, and we're taking advantage of that volatility. But we must say that that volatility is likely to be with us for 6 months. The markets tend to focus on risks for about 6 months before they get distracted by something else. But it's unlikely we'll see a strong run from Chinese tech stocks or a sustainable run in the next six months. But focusing on that, so we had the China's State Council and the Communist Party's Central Committee releasing a 5-year blueprint calling for greater regulation of the economy. No markets lack regulation, so that certainly was a cause for concern. We then had China passing legislation setting out tougher rules for how companies handle user data. Consumer data protection is definitely something that is a global issue. And locally, we've seen the POPIA Act. It's something that needs to happen. China is just following suit there. They did reduce or change or they tightened the online gaming rules. So online gaming was restricted to 1.5 hours a day during the week and 3 hours on the weekend. And that's been cut to 3 hours a week, 1 hour on Friday, 1 hour on Saturday, 1 hour on Sunday, and 1 hour on public holidays, with the proposed time of 8 to 9 p.m. for that 1 hour, which is in itself doesn't make any sense, because why you need to wait till 8 o'clock at night on a Saturday to play your game, and why your miners need to stay up till 9 o'clock at night so they can play games is curious. So there's potential that those rules will change. Ironically, since that was announced, Tencent and Process have bounced 12%, and Naspers have bounced 12%. So maybe the market was expecting a lot worse worse than that. They also are seeking. There was proposed legislation put out seeking to control algorithms. This particularly impacts advertising revenue, and it was one of the concerns that Tencent management raised at their results recently. Not so much a concern about the impact on gaming, but the impact on advertising, as advertising, a lot of the advertising revenue comes from the educational sector, which has been clamped down on, but also the algorithms. They want to enforce rules which prevent the algorithms from using practices that encourage high consumption. So effectively, they want to stop marketing from doing its job, which is quite confusing and complex. And I don't know exactly how that's going to happen. So it hopefully won't happen. And again, it's a draft legislation. And if anything, we know, yes, China is a century-driven economy, so they certainly can make sweeping reforms without any feedback, but is likely to be some middle ground that has been met. And the reason for that is that China can't afford to self-inflict an economic collapse. There is a lot of debt. They're very worried about unemployment. They're very worried about shifting to the new economy. And we did see a very severe slowdown in China in the month of July. And the chart on the right there shows not only China's top graph is China's equity underperformance relative to EM. That's the investable indices that shows the impact of the tech, but also linked to their risk. But it also reflects the slowdown that we saw in China. So the Chinese all-system financial aggregate, which is basically their credit extension, if you want to look at it, how much money is being lent or borrowed, that fell by 71% in July. So that was quite a severe contraction. And some of it was temporary. It was some of it was linked to the new COVID restrictions, severe flooding, and also global supply chain disruptions. But some of it was also linked to an actual slowing down of their economy. So it is likely that we will see some sort of support, an additional cut in the reserve rate requirements to support lending, or lifting the foot on the regulations slightly on the tech sector. So we are expecting some sort of short-term support from the government to avoid a hard slowdown in China. And that's why we're comfortable continuing the overweight emerging markets. And our China, now we've got some China onshore, and we've got our Chinese small Chinese tech exposure as well. Moving on to South Africa. South Africa is always a bit of a mixed bag. I suppose the rest of the world's looking more of a mixed bag these days as well. So we're not alone in that point of view. And I suppose that's why equities as well, despite their very strong run in the first quarter of the year, as we predicted, the second quarter and now July and August, so most of the third quarter, have seen sideways movements in equities, choppy, a lot of volatility, and we're trying our best to harness that volatility rather than take any major directional views. South Africa remains the same, a mixed bag at best, again being polite. So the major news this month was the reshuffle of the cabinet, in which President Ramaphosa abolished the security ministry and placed political responsibility for the spy agency within his office. Now, that's certainly on the face of it something that should be a big concern. It starts to sound a bit like other countries that are dubious in nature. But I think given what happened with the looting and violence, it's actually probably a move in the right direction, and it certainly was well received by the market. What wasn't well received, and certainly caught foreign investors by concern, and South African investors, but led to a major concern with foreign investors, was the exit of our much beloved Finance Minister, Tito Mboweni, who's always been seen as a strong pro-reform driver, and certainly has done a great job at the helm as Finance Minister for the short time he's been there. So it wasn't so much the fact that he left, but the fact that it was unexpected. It was very close to the October medium-term budget policy statement, which is now the November medium-term budget policy statement. And we're going to see his replacement, Enoch, who's coming in, and all eyes onto what that means. So this replacement is seen as a centrist, which on the face of it is good. However, at the same time, Tito was fighting very hard on the wage deal, and quickly accepted that and added an extra 38 billion rand to the budget. So that is a bit of a cause of concern. Fortunately, the budget can afford it, and we've got windfall inflows from resources. Again, something that we're not going to have for long, something that doesn't happen all the time. It's a once in a decade windfall that we see in commodity prices. So we really shouldn't squander it, but we can afford to use it to pay cash bonuses and a slightly higher wage deal. As it stands, the 1.5% wage deal is actually not too bad. I mean, it's certainly well below inflation. So maybe it's harsh to criticize. I think the key thing to look out for is going to be the February budget speech. And as I said, October or November now, there aren't normally too many policy changes, and there is quite a strong windfall to spend. February is going to be much harder. There'll be new policies that will come in. One to look out for is the calls for a basic income grant, which South Africa certainly can't afford with its current high unemployment rate. So we'll see what happens there. We did speak of the unemployment rate. We did see that was announced in August, and unemployment rose to 34.4%, which is the highest in the world. So South Africa has a gold medal, not only in swimming, and that was fantastic. We're all very happy to see our gold medal in swimming, but we also have a gold medal in unemployment, which is not as exciting to see. At the same time, potentially good news, Stats SA revised South Africa's GDP to 11% higher, which sounds fantastic. An extra $37 billion added to the GDP, which reduces our forward-looking debt to GDP numbers by raising the denominator. So it's a bit of a cheat, but it's still, debt levels fall, prospective debt levels fall from 87% to 77%. In 2023, 2024. But, okay, there's always a but. That extra spend that was all on the consumption side. And consumption doesn't improve potential growth. It just is money that was spent, it was consumed. And potentially that extra 11% that we weren't expecting in the consumption was a result of money which we didn't think was in the economy. And maybe that was some of the corruption and the money that disappeared. Maybe at least some of that was spent in South Africa, and it wasn't all taken offshore. That regardless of what that consumption is, it won't be repeated. What you do need for growth to recover is you need two things. Growth is made up of the number of workers and how well those workers work. So it's your labor supply and your productivity. Now, with the highest unemployment in the world, you must think that South Africa has an endless level of labor supply, but unfortunately we don't. And our productivity is also incredibly low. And this brings us to the chart on the right. So in the short term, I'm very concerned about Eskom. I'll talk a little bit about that later, but long-term growth is very much dependent on your productivity levels and your labor supply levels. This chart shows on the vertical axis our GDP per hour worked, so it's like a productivity measure, and the horizontal axis is the quality of education. This is sourced from Colchester, who sourced it from the World Bank. And circled there in green, right at the bottom left, very sadly, is South Africa. We have the worst education system in the world, which means this correlation that R squared of 0.59 is no surprise. It means we have the lowest productivity in the world, which means we have the lowest GDP growth in the world, which means it's very difficult for us to grow out of debt, and it's very difficult for us to add jobs, very difficult for us to encourage investment because we have low growth. So this is something that urgently needs to be fixed it's definitely South Africa's biggest hurdle over the medium and long term, and what has to have the largest focus. Unfortunately, it's not just a matter of spending money. So if you look at the detail, South Africa actually spends a lot more than its peers. As a percentage of GDP, we spend a lot more than emerging markets And as a percentage of GDP, we spend a lot more than some developed markets. We're just not spending that money well. So you can get into a whole debate of why that money is not being spent well. And yes, there are a number of reasons that are linked to our past and linked to our present, but it is certainly a key cause for concern and a headwind to our long-term growth. So we need to see our education system improving before we can see anything else happen. Yes, there are short-term ways to fix GDP with a lot of low-skill infrastructure and on-job training, and that is something we need to look at as well, and is being looked at, which is great. But this is a key cause for concern. In the short term, the other record that we had in this year, the South African gold medal, is load shedding. And for the first 6 months of the year, we're on track for the worst load shedding that we've had in our 13 years of load shedding, which is not good, considering that we should be getting better after having 13 years to fix this, and not worse, particularly as growth hasn't been anywhere near what was projected, which means that we're just doing a horrible job on that. But the good news is that the limit on self-generated power without a license has actually been lifted from 1 megawatt to 100 megawatts. So it'll take some time, but we are likely to see some acceleration of that. And we already are seeing some of the mines putting proposals together and trying to raise money for them to build power plants on site and remove their links to Eskom, as well as a number of municipalities are doing the same thing. Yeah, on the cabinet reshuffle, hopefully it does consolidate Ramaphosa's power and hopefully will allow further reforms or faster reforms. Looking at the records from the ANC's National Disciplinary Committee dating from 2014 to 2021, so the last 8 years, shows the party has not, this is very important, the party has not decisively disciplined any party member for corruption. Nothing. So when it comes to reforms, that is certainly something we need to start to do to set an example to get things happening. And maybe that's also why education hasn't been as effective as it should have been, despite the money that has been spent in that area. So once again, we'll wait and see. South Africa knows exactly what it needs to do. We've got an amazing constitution. We know we've got an amazing legal system. We've got an amazing financial system. We know what needs to happen. We've got amazing policies. It's just getting them done and executing them. One area that has been very successful over the last month is the JSE. They actually had such a record month. They had a record day with the Naspers process swap. They had such a record day with, I think, 7 times the average daily turnover. The next day, their systems fell over, and they had a day of hangover as a result of the huge volumes that went through their system. So I'm sure they are very happy. So we did have process Naspers share swap go through. Unfortunately, it does mean that South Africa's weight in the MSCI Emerging Market Index falls from a paltry 3.9% to 3.4% due to the lower Naspers free float. And that's very sad. I mean, foreign investors are already boycotting South Africa because of our lack of reforms, despite the great value. And that's definitely something you can't argue. South African equities are cheap. So despite the great value, South African foreign investors are going, oh, it was 4%, now it's closer to 3%. Really, it's a rounding error. Let's look at emerging Asia, where we're getting much more exciting EM exposure, which much better growth, 7% versus 1%. Reforms are in place, things are happening. They've got stable electricity production, education is stellar, etc., etc., etc. So it's just another sad tale. We also have seen a lot of change to the cap swix. So the cap swix went from capping at 10% just Naspers to a temporary cap at the first rebalance in August, where they combined the weight of Naspers and process to cap at 10%. This is now going to be a second change, a second temporary cap at the September rebalance, where Naspers and Prosus will be separately capped, each at 6%. And a white paper has come out, and likely in December there'll be a fourth and final cap that will be applied to cap stocks. All of which means a lot of turnover. So we're going this each time there's been a reiteration. There's been buying Naspers, selling Prosus, then buying Prosus, selling Naspers, and then selling Prosus and buying Naspers, and it's led to a lot of turnover. JSE are loving it. I think it's not great for funds. That's why we stick to the Swix index in our funds. Yes, there is some concentration, but the cap Swix has higher turnover at arbitrary levels. We've just seen how arbitrary those levels are. First, it was a capping at 10% combined. Then it was capping at 10% of only one share. Then it was a capping of combined 10%. Now it's capping at 6%. And who knows what the capping will be at in December. But it's a lot of extra costs. And again, it's tax. You can get brokerage down to almost negligible levels, but you are paying 1/4% on tax for every time you buy an equity, which is very expensive. That's some of our funds, the fees in our funds are that per year. Brokerage for some direct market is close to 5 basis points. You're paying 25 just to tax, and that's let alone VAT on insider trading levels and other things. Anyway, so it was quite a big market moving event in South Africa, and we stick to our Swix benchmark where possible. We do, of course, track the capped Swix, and we track the capped ALSI, which has stayed at 10%. Funny enough, that the 6% change didn't impact that index, and we do track a number of other indices. So whatever you need, we will track it for you. Looking at the rand and bonds, we remain overweight global because of the low growth in South Africa and because of the great diversified growth globally. And we remain overweight South African bonds locally relative to cash and credit just because of the incredibly high yields. Some of the highest yields in the world still, because there's a lack of reform and potentially now a new finance minister and foreigners remain concerned about debt consolidation within South Africa. So we remain overweight South African bonds within our balance funds and within income maximizer. So just going through this chart, if you want to put money into your bank account, you're probably getting around 3%, depending on what your level of cash is in your bank. If you put it into the money market, the Sygnia money market unit trust, you can get 4.4%, and there's no fees. So our zero fee campaign has been extended as long as you invest by the end of this year, and then that's zero fees for the whole of 2022. So you get 4.4%, no fees. Enhanced income, 6.5% current yield. So that's an extra 2% roughly, which as a result of credit. This is a low risk credit fund. It doesn't have exposure to preference shares or equity or bonds. So it is effectively a longer term money market fund. So you are paying 6.5% there, or getting 6.5% yield. Income maximizer is our best blend income assets. There was a change in the month, so that fund has got predominantly exposed to bonds at the moment to get access to that great yield, and it's yielding 8.6%. We did decrease the property exposure slightly. Properties had a great run, and we want to lock in some of those gains, and we increased credit as a result. Credit has got a lower yield than property at the moment, but we just think that we reduce some of that risk. All bond unit trust, again, zero fees until the end of December and zero fees for 2022. If you're invested by the end of December, it's a 9.3% yield, but it does have some capital volatility. You don't have the same capital guarantee that you'd have, or certainty of capital that you would have lower down the spectrum. And our enhanced all bond unit trust, which has got an additional credit yield in it, and that's 9.7%. So those are our income funds, and we remain overweight those portfolios. We're just finishing off on positioning. We've got a small overweight to our bond alternatives because we don't hold any global bonds. So that's our Sygnia global property ETF, and that remains an amazing performer. It's up to over 20% year to date. And we've got a small overweight in our disruptive technologies growth satellite. And that's currently in fourth industrial revolution without any exposure to FANG. We've got our largest overweight to emerging Asia. This is exposed to our EM. The biggest part of that is our EM index, EM50, the ETF. We also have some exposure to China onshore, the China Asia market, and we've now got a very small and first exposure to China tech. So that has stayed the same size. We just did some rotating within that building block. Health innovations, we've got exposure to our healthcare ETF, and we've got exposure to our health innovation trust. So we've got exposure to both of those, and that's a medium overweight. And value is a medium to large overweight that increased from +2 to a +3 this month by selling out the S&P 500 and buying US value. So we do think that value will do really well over the next 6 to 12 months as US yields rise, and just because they did recover quite well in the first quarter of this year, but they've given up all the gains, or most of their gains, over the year-to-date space. So looking like a good place to get in. Again, this is a grayed out block because we don't offer this as a product. We are firm believers in our low return, high volatility next decade outlook, which means you need to look for growth in areas that are uncorrelated to global GDP growth, and that's where you need to find areas that are growing in market share. So emerging Asia with their emerging middle class, health innovation with aging populations and new solutions coming out, disruptive technologies with new market shares that they are taking advantage of. And bond alternatives, and that is slightly, there's some growth in our property ETF because it is linked to growth areas in the property space. So a lot of healthcare exposure, a lot of cell tower exposure, and things which aren't traditionally linked to your normal consumer and resort exposure. So that is a wrap. Let me look at Q&A and see what questions have come through. There's just someone asking for clarification on how he's asking for clarification on what I mean by overweight. So that's relative to the MSCI All Country World Index. So our benchmark on our global equities is MSCI All Country World, and we take positions around that. So the majority of that is the US. The US makes up the biggest allocation, more than half of the MSCI All Country World, and we take positions around that. So we go overweight emerging Asia, overweight healthcare, underweight US. Sean asks, which of our funds follow our house view the closest? All of our funds follow the house view in the same manner. So all our global balanced funds have the same exposure. So if we're underweight South African equities by 1%, all our global funds have the same underweight 1%. If we overweight healthcare by 2%, all our global balanced funds have the same overweight. They just have different starting points. So the high risk funds have more equities to start, and the low risk funds have less equities to start, but they all have the same exposure. If you want to take bigger views than what we do in our house view, then you'd need to get invested in one of our funds in addition. But whether you're invested in the Skeleton International Equity Fund of Funds or the Sygnia Equity Balanced Fund of Funds, International Balanced Fund of Funds, all of our funds have the same house view. We align them all identically in terms of our best view. The one thing that does change is the amount of active and passive. So there are certainly some funds have more domestic equity active managers and domestic bond active managers, and some have more passive, but otherwise they are the same. John asked more about the 30% offshore exposure in our LA. So good and bad news, John, unfortunately. The good news is that we are below our SARB limit. We are scraped in at 30.8%, 39.8%. So we have submitted that to the SARB. We should be lifting our restrictions. However, we want to manage that appropriately, and we are looking into it. So there's no point in opening it up today and by tomorrow we've got to close it again. So we are looking at the fairest ways of opening that, and there should be some news that comes out on that soon. But we want to make sure that we don't jump in and out of being in breach each day, and we only are just within that level. Daniel asks, global equities are preferred asset class. Would South African equities be second in place? So I need to balance that with a statement on liability management first of all. I think that it's very, very important. I mean, I'm an actuary. My grounding was on the risk side, liability side is probably a better way to put it. And I then grew into CFA and investments and hedge funds and absolute return and the like to look at the asset side. But if you are invested in South Africa and if you're saving for your retirement and you don't plan on immigrating, then I think it's important that you have a balanced portfolio which acknowledges your RAND-based liabilities. So there, we think that roughly between 30 to 35% is probably, depending on your risk, but as low as 15% global and up to maybe 35% global is appropriate in a balanced portfolio to manage your savings. If you've got excess savings, so money that you don't need for retirement, that is surplus to matching those, that can easily be 100% in global equities. And when you're in global equities, that South Africa makes up less than less than a percent, rounding error within global equities. So that you can focus on global equities. But in the balanced portfolio where you do need to have some exposure to the cognizance that you are saving in rands, well, obviously our biggest exposure in our funds is South African equities. So while we overweight global equity, our net exposure is about 25%, while we underweight South African equity, our net exposure is, sorry, in our high risk fund, our net exposure is 45%. So South African equities do the job. When it comes to your best South African rand-based long-term asset class, South African equities will give you your best return over the next decade compared to South African bonds and South African property and other asset classes. So yes, they'll get the job done. They may not get the job done as well as global equities, but compared to the alternatives, they will get the job done, and they will more closely link your liabilities. And the reason for that is important. There are times when the rand has strengthened massively. Last year it went from 19.5 down to 13.5. Now, if all your money was in global equities, despite the really strong growth, you're looking at close to a 40% fall just from rand strength. You don't want to be forced to sell that to live off in that year because of the strength. So that's why. And South African equities, while they haven't done as well, they had a strong year because they benefited with the rand benefiting. So it's important to balance liabilities and assets. Now I can't tell you what that ideal split is because it depends entirely on your risk profile, how much money you've got saving, what your liabilities are, and a number of things which your financial advisor needs to help you with. But within the South African context, South African SA equities, they're your best alternative. Yeah, Wayne, I agree with you. We need reforms desperately. I'm not sure how that happens. We know what we need to do. We keep holding our breath and waiting to see execution take place, but I'm not sure how that happens. Kubus asked a very good question on Chinese debt, and this is a fascinating question, and it's certainly one of the reasons that people are most concerned about China, and the bears on China and the naysayers on China who've avoided it for the last decade have mentioned Chinese debt as the major issue. And Chinese debt is a concern in certain sectors, but you always need to look at net debt. So it's very important to look at net debt in China. Not only is China's debt low, I think the government debt to GDP is 40%, which is amongst the lowest in the world. If you add in municipalities and shadow debt, maybe it rises to 70%. But they've also got amongst the highest savings rates in the world. So if you look at their savings can almost, and especially if you look at their sovereign wealth savings, those savings and the government's savings and sovereign wealth capacity eclipse a lot of that debt. So on a net basis, while yes, there can be some debt concerns, they can cover that debt without too much of a worry. Not many countries can say that. Certainly, not many developed market countries can say that. And they are also the reforms have taken quite a lot of steps forward in the last 5 years. They're opening up their economy a lot, particularly in their bond space. And a debt crisis is not something that I'm too concerned about. I'm also not too concerned about a Chinese currency crisis. If anything, we've seen the Chinese currency strengthen quite strongly over the last 6 months. And I think we're likely to see more strength in the currency, not less strength. So, geopolitical risk is certainly a concern for China. Trump's trade wars was a concern, and regulation is a concern because they are a market-driven economy, and civil unrest is a concern. But I'm not too concerned about debt so much. That's one of my lower concerns when it comes to China. China regulatory crackdown is expected to focus on healthcare. So healthcare is mentioned indirectly in the fact that they have put out a 5-year plan, and they do want to do anything that is good for the emerging middle class. And I wish our country would focus on the middle class. There was that green paper that was put out last month, which basically tried to tax the middle class to death to try and give everyone free healthcare, and fortunately has been revoked. So there are rights, and certainly universal healthcare is very, very important, but there are ways of going about it. China is going to focus on some sort of healthcare, universal healthcare. I don't expect them to be a strong regulatory focus on it that penalizes that sector. There don't seem to be too many things going on there yet that need crackdown on. So property is something that could face further headwinds. We've already seen the platform or tech space, the education space, the gaming space, the advertising space. We could see a bit more coming through in the property space. Healthcare is mentioned, but I don't think there's going to be anything too concerning. That said, our healthcare fund doesn't have any emerging market exposure in it. We've chosen to go for the developed market healthcare. So we've got a lot of Swiss exposure, Japan, Europe, US. We looked at India. We wanted to get in India exposure in our funds because India does have a lot of low-cost production, but there's just not enough depth. There are 1 or 2 counters in India, and they really are playing on very, very thin margins. They do great work pumping out huge volumes at very low cost, but the volumes aren't there. So we continue to believe that from a healthcare perspective, it's best to be exposed to the developed market, and that's why we use the developed market index, the developed market universe, as the starting point for our healthcare unit trust and our healthcare ETF. Question on tapering and the impacts that tapering have. So you need to go back to 2013 May when tapering happened and the taper tantrum happened, and the dollar bonds sold off everywhere. I mean, the amount of volatility in bonds was scary. Bonds had more volatility than equities. So the biggest impact would be bonds, developed market bonds, US bonds, emerging market bonds, and the impact on other sectors is varied, and I think that the impact that we'll see this time is going to be different, mostly because the US has learned. I don't even know if we'll get to the point of the US selling bonds. So the harsh times we saw was when the US just wanted to sell bonds. At the moment, the tapering is only talking about buying less bonds. So as long as that's done in a slow, appropriate manner, I don't think we're going to see a taper tantrum. But it will be bad for equities, US equities in general, because what it will allow is so right now, the US is buying bonds. When they buy bonds, they push up the price and down the yield. So the yield is something that's used as a risk-free rate, which you price equities off. So when there's less demand coming through, less US government buying of bonds, those bond yields will rise, which means that the benchmark that you're using to price your equities becomes more expensive, and tech in particular. So we think that tapering, if you want to call it, but it's more, tapering is going to go hand in hand with steepening the yield curve and growth recovering. All of that will lead to banks and industrials doing better than tech, and probably FANG being one of the worst relative underperformance compared to other sectors. And that, on the noonday gun, is unfortunately all we have time for. Thank you very much for joining. Thank you very much for the questions, and have a great month. Stay safe, stay warm, and I look forward to seeing you guys all next month. Cheers.